our next guest. And I am going to bring in Mark Sherwood from iPartners today to discuss alternative investments and the Alternative Investment Conference. Mark, thank you so much for your time today. Now, tell us a little bit about the iPartners Alternative Investment Conference.
Yeah, hi Kyle. We hosted it last week, and it was really an inaugural conference because we sort of view that it could become the go-to conference for alternatives in Australia. And I think the vast number of people that we had register and attend really speaks to the increased interest in alternatives, particularly from private high net worth investors and privately advised investors. So the conference spanned right across all the subsectors of alternatives, be it private credit, private equity, venture capital, agriculture, and global funds as well. So it sort of went right across the different areas that we specialise in and concentrate in, and we tried to cover a cross section of each one of those areas to give the audience a really sound understanding of the themes that are currently going on.
Just a question, and it might be a little bit left field, but we've had a little bit, like you said before, there's this kind of really accelerated drive to alternatives, I think because of the market backdrop, and there is this rapid re-education of investors going on right now to sort of get them across what it all means. If there's perhaps some misconceptions or some common misunderstandings from investors when they're exposed to this space, what are they, and what sort of lessons do you think that particularly out of this conference were learned by prospective investors?
Yeah, Kyle, I think there's a bit of a misconception that the term alternatives is something very exotic, and it doesn't necessarily have to be at all. In fact, most of the transactions that we look at or consider for investment can be simple corporate loans. They can be simple debt instruments in the private credit arena, or they can be simply an equity stake in a property asset, for instance. In the kind of private equity type arena, or an equity stake in a business in that light. So I think there is a bit of misconception sometimes that alternatives fit outside the stocks and bonds part of your portfolio, but they aren't necessarily anything exotic. A lot of the time, the deals that we look at are very correlated to people's normal daily life. For instance, one of the themes that came out of last week's conference, I would say, is there's an increasing demand from private investors for agricultural assets. Most of the agricultural assets that we look at are involved with people's daily food intake in some way. So yeah, I think that's a real misconception that people kind of see the term alternatives and think we're talking about something that's exotic, or perhaps something that's really risky. And a lot of the deals that we do, particularly I would say in the private debt arena, can be very much on the conservative side of investing.
So if we were to sort of paint a word picture, and it's one that I've asked other folks in the space, because I myself, as a humble retail stockbroking alumni, learning as well. But if you were to visualize the risk curve, we associate government bonds down the bottom with maybe some corporate credit, then you get to your equities and your small caps, etc., etc. When you look at different types of alternatives, where would they be laid into that curve? Again, for those folks at home who might be interested in getting this sort of, I guess, diversification tool that can come with alternatives.
Yeah, it's a great question. Look, I would say right across that spectrum on the upward risk reward proposition. So again, it really depends on what part of the alternatives sector or subsectors that the current deal that you're looking at sits. So if we're talking private equity, we're talking a fair way out that risk reward spectrum. Venture capital, obviously, very much out that risk reward spectrum. But if we're talking conservatively exposed private debt to a very strong balance sheet company, albeit the company happens to be a private company or has stayed private perhaps for a long time, and just has decided not to become a public company, that can be right down the bottom end of the sort of risk reward spectrum. And obviously that would come with a lower yield, but that would come with a lower risk spectrum as well. So interestingly, to your question, it actually the sector of alternatives goes right across the sort of risk reward curve, really depending on what type of particular deal that you're looking at.
So I think one thing that most people I would imagine are aware of is that there's that kind of illiquidity premium that's baked into a lot of these prices. Amongst that, perhaps you can expand on it. But is there anything else that you might see as potential shortcomings, or not even shortcomings, but risks that you might have to consider when parking some of your wealth in alternatives?
Yeah, touching on your comment about liquidity or illiquidity in alternatives is a really good one. I mean, I think in the past, a lack of liquidity in alternatives, and particularly even before that, a lack of access was the biggest problem for private investors, particularly the institutional investors of the world, the largest players have always had the best access to alternatives. What we've been trying to change over the last few years is that access mechanism, particularly for high net worth private investors. In terms of that illiquidity premium, it's actually a real strength in the alternative spectrum, particularly in private credit, which we've spoken about here today. In that getting paid that additional premium in terms of yield return, as long as it's well negotiated, it can really make the risk reward proposition of any individual investment much stronger. And that really suits the type of investor that says, well, I don't really need to sell this asset before its defined maturity date anyway. I don't need liquidity. I'm happy to hold that asset for its 2-year term if it's a 2-year note, for instance. So I think that's a real strength of the alternatives arena, being able to negotiate those premiums for illiquidity.
What about, almost as an extension to that, I guess you could call exit liquidity? We're sort of used to that concept when people are trying to find it in stressed markets and might try and drum up some interest for a stock to be able to offload what they've got. But in the alternative investment space, say for retail or private investors, what's the role of institutions potentially in providing that eventual exit liquidity when you do find that you want to sell that asset?
Yeah, institutions, the large institutions are actually very valuable to the kind of private investor in alternatives. And the reason why I say that is because often your large institutions can be your source of exit. So if you've been providing debt to an emerging, growing company in its sort of earlier stages of growth, chances are that company was probably too small to get institutional funding when we started to provide them a corporate debt facility. The investors have obviously been benefiting from those yield returns that come with that. But then the company's grown in size, and essentially the deal might get refinanced out by a much larger institution. So the large institution becomes the finance or refinancing angle that pays out those earlier investors. And the exact same thing can happen in private equity as well. So similar to private debt, if you've been taking early stage exposure at the equity level to a growing emerging company, often as it grows, it needs larger volumes of equity. It goes to much larger investors, and perhaps the early adopter might choose to utilize that as their exit point.